welcome to all of you who've logged in today to listen to this talk. I think we are at a very important juncture for the global economy. A lot of interesting things have happened recently, and I thought I would talk about that and discuss, what I see as the prospects for emerging markets. As Prashant said, I invest in about 80 emerging markets around the world. Our fund is about 1.2 trillion assets under management. So we get to meet nearly all the countries and learn from their ministries and governments and central banks as to what is happening in their own countries, because we invest in their sovereign bonds and their local bonds, as well as in their currencies. So what I want to do today is talk a little bit about what is happening to the Fed. Why are things changing? What is the outlook for the US economy? What is the outlook for the major economic centers of the world? And then what is the outlook for emerging markets? And then maybe spend a minute or two on India as well, although I'm sure that everybody here knows what is happening in India very well. I thought here I will give much more of a global perspective. And of course, I'm going to touch on the dollar and what I expect there to happen. So the biggest event that has happened this month in global financial markets is that the Federal Reserve, which is pretty much the central banker to the world in some ways, because it sets interest rates in the largest, not only the largest economy in the world, but also the largest financial center in the world. The Federal Reserve, in its policy meeting earlier last week, signaled that it was going to pivot to rate cuts. This comes after a hiking cycle where the Federal Reserve has been hiking interest rates for 2 years and has jacked up interest rates to the highest that they've been since the 1980s. So some of you may be aware that the policy rate that the US is at right now is 5.25% to 5.5%, which is, by recent history, very high. And the Fed has been on a hiking cycle and trying to get inflation down. But in this policy meeting, they basically said that we are done hiking and the next move is going to be a cut. So that is a pretty significant event for financial markets and for interest rates around the world. Basically, what the Fed is saying is that inflation is yesterday's problem. And what they are focused on right now is growth going forward. And that has implications for everybody, right? And I'm going to talk about why that has implications for everybody, why this has implications for emerging markets and also for us, for everybody in India. So let me first start by talking about the US economy, right? The US economy has had very high inflation for the last 2 years. It started right after the pandemic, but it picked up in 2021. And throughout 2022, it was accelerating, especially after the oil price increased after the war, the Ukraine war. And it had reached almost double digits, which was also unheard of, right? And core inflation was rising. Food inflation was already high, and oil prices and oil inflation was rising. So everything was rising. And the central bank was very worried as to how are we going to control inflation. Now, a series of rate hikes, as well as many other developments over the last 12 months, has meant that inflation has been gradually coming down in the US. Core inflation, which is the indicator that the Fed looks at very closely, is now down to 4% and is on a downward trajectory. Headline inflation has a 3% handle. So it has come down quite dramatically. And it is not only in the US, it has come down around the world. In most countries this year, inflation has been coming down, and it's been coming down dramatically. In fact, the UK reported inflation numbers yesterday, and their last inflation print for November was only 3.9%. They started the year with inflation at 10%. So you can tell what is happening. In fact, some large economies are seeing deflation. So China is seeing deflation. It's not seeing any inflation. So for everything that we worried about for inflation over the last 2 years, it seems like this is yesterday's problem now. At least the largest central bank in the world, the most important central bank in the world, is saying that we think that inflation is yesterday's problem and we are going to cut rates. Now, markets have started pricing in a lot of rate cuts next year. So the central bank in its dot plots indicated that they would cut rates 3 times next year. But markets have gone ahead of that. And they have expected, and it keeps changing daily, they are now expecting the Federal Reserve to cut anywhere between 5 to 7 times next year. So policy rates could go down by 100 to 150 basis points. That's a lot of rate cuts now, which means that interest rates globally are going to fall because every interest rate is linked to the 10-year US yield. That is the risk-free rate that we use, whether it's for corporate borrowing or bank borrowing or for trade finance. Every interest rate is linked to the risk-free rate, which is the US Treasury yield, which is the 10-year yield. And that has come down quite dramatically, or the market is expecting in 1 year's time that rate to come down quite dramatically from 5.25, 5.5 right now to even under 4% by the end of next year, and even further in 2025. So that's a series of rate cuts that the Fed is expecting. 2 reasons for that. One is that it's expecting the economy to slow gradually, and second is that it sees inflation coming down. So when growth is lower and inflation is lower, what should central banks do? Well, they should cut policy rates. And that's what they're doing. They are indicating that the first cut can be as early as March next year. And then they're going to continue through a series of rate cuts. Now, very interestingly, the Fed is also forecasting that the US is going to have a soft landing, which means that the economy is going to continue to grow. It's going to not have a recession. Now, if you remember, a year ago or 2 years ago, everybody was saying if the Fed starts hiking rates, then the US will enter a recession. Well, the US economy has confounded all critics. This year, the economy might grow over 3%, and next year is expected to grow somewhere between 1.5 and 2 percentage points. So it has continued its expansion throughout 2021, 22, 23, and now even 24. So really, there's no landing, or there's no recession in the US, which has confounded all the forecasters who were expecting growth to slow down and the US to have a recession, et cetera, et cetera. Now, this kind of environment where the Fed is cutting rates, growth is still okay. It's not very strong. It's not very weak. Is actually a great time to be in emerging markets, right? Because you worry when rates are going to go up because your cost of borrowing goes up, and that leads to capital outflows from emerging markets. But if rates are coming down and there's still growth, what do you expect? What's going to happen? There's still going to be export growth, right? You're still going to produce goods and services to export to the largest economy in the world, the US. And that means that it's a very benign environment for emerging markets. So that is the basic construct as we enter 2024. Of course, let me run through a few of the large economies and then the big EM regions as to what is happening in each of them, and then talk about what can happen to the dollar, etc. The second largest economy is, as you all know, is China, and China's growth is actually struggling. So it is not imparting any inflationary pressures to the global economy. In fact, the price there is deflation right now in China. So, and it is not growing as fast as expected. So it does not look like China is going to be a force for inflation. Growth is expected to pick up slightly next year, but it looks difficult to see it, roaring growth, given that there is a property price bust that China has to deal with. The rest of Asia, growth is strong, but inflation is relatively contained. If you look at a large country like Indonesia, inflation is only at under 3%. In Malaysia, it's under 3%. In Thailand, it's again in deflation. In Korea, inflation is coming down. In Taiwan, inflation is coming down. In India, it's higher than elsewhere at 5.5, 5.6%. But it's not on its core inflation is trending down. So we're not seeing big pressures on inflation in most parts of Asia. The one part that I didn't talk about is Japan. Japan is seeing growth, but Japan is a low inflation country. So it will see inflation around 2.5%, but it does not look like it's going to be a very strong bout of inflation in Japan at this stage. Now, moving to the other parts of the developed world, Europe again is seeing inflation come down across the board. Some parts of Europe are in recession, such as Germany. The latest data from the UK was also negative. So there is a growth slowdown in Europe, but it is not as deep as people feared at the start of this year. Remember, at the start of 2023, most analysts were expecting that Europe is going to go through stagflation, which means negative growth and higher inflation. Well, growth is weaker, but inflation is also coming down, which means that Europe also will start cutting rates at some point in 24. So policy rates everywhere, or interest rates everywhere, are on their way down. They're not on their way up, which is very different from the last 3 years, where interest rates were rising across the board. What about other parts of Europe? What about Latin America? What about Africa and the rest of the Americas? So very quickly, in Europe, the rest of Europe, inflation in Eastern Europe is coming down very dramatically from mid-teen levels in places like Hungary and Poland and Czech Republic. They are coming down to mid-single digits, 4, 5, 6, 7%. And it continues to come on its way down. So inflation is on its way down across East Europe. That's true. No matter which part of Europe you look at, even in Russia, inflation is coming down. In the Middle East and in Africa, we didn't see the same levels of inflation as the US, but there also inflation is beginning to come down. And that is allowing central banks there to start thinking about cutting rates. Some central banks in Eastern Europe have already cut rates, Poland being one of them, but there are others that are also going to cut rates going forward. If I look at Latin America, in Brazil, inflation has come down again from 12, 13% to 3, 4%, right? So again, a very sharp fall in inflation, and growth is picking up. In most of Latin America, growth rates are going to be stronger next year than this year. So the environment that I'm describing is a great environment, right? Inflation coming down, growth going up in most parts of the world, interest rates coming down, so you can fund yourself cheaper. And that is why asset prices everywhere, whether it's India or the United States, stock prices are going up, right? And asset prices everywhere are going up because we are looking at a situation where a world which was hit by COVID and then hit by the war in Ukraine is now recovering, and recovering faster than anybody expected. Everybody expected there to be a global recession. Well, that doesn't look likely. Growth is surprising to the upside. Everybody expected stagflation. Well, inflation is surprising to the downside. So the world has turned out to be a lot more resilient than we expected going into 2023. So as we go into 2024, the environment does look quite optimistic for emerging markets. Remember that emerging markets have had a really tough time in the last 10 years. First, they had the taper tantrum in 2013. Then they had Chinese devaluation in late 2015, which carried through into 2016. Then there was the COVID. Then there was the war. So growth has been weak, inflation high, and living standards have not really improved in most emerging markets. We've seen that China has been slowing down quite dramatically after COVID. But that seems to be, the macro environment seems to be improving. for all of these emerging markets. As I said, Brazil is showing strong growth. Russia is growing. India is growing very rapidly, as we know. Most of Southeast Asia is growing and growing rapidly. Indonesia is growing at 5%. Philippines is growing at 6%. Thailand is supposed to grow at 3.5% to 4% next year. Malaysia likely to grow at 5% next year. So large parts of the world are growing again and growing pretty strongly. It's not weak growth. This is pretty decent growth. And as I said, the same can be said about TAM, the same can be said about Eastern Europe. Emerging markets, which is why I titled this talk the boom in emerging markets, because the Fed is easing rates. Now let me talk about the dollar as to why, and this is really important because a strong dollar means weaker emerging market currencies. Weaker currencies means that there is higher imported inflation. Weaker currencies also means that all the emerging markets which have high debt have even higher debt, right? Because they have to pay all the debt that they have in external currencies, dollars and euros and so on, with whatever revenues they get from local currency. So it is very difficult for them to fund their debt when their currencies are depreciating. So when interest rates are lower in the US, it typically or should mean that the reasons to buy dollars is much lower. You all are students of economics. You must have heard of uncovered interest parity, where capital flows are driven by interest rate differentials. If interest rate in one country is 10% and interest rate in another country is 2%, where would capital flow? Well, to the country with interest rates at 10%, right? So if interest rates in the US are coming down from 5.25%, 5.5% to under 4% and to even 3%, that means that reasons to hold the dollar are reducing because you're not getting paid that much. You're not getting that much interest rate to hold the dollar. So people are going to go and invest in other currencies, in other markets. You can get 7% in India. You can get 8% in many other countries. If you get 7, 8%, you'd rather take that, right? As long as your currency does not depreciate. Why would you take 3% in dollars if you can get 8% in INR and the INR is not depreciating? So uncovered interest parity is a very powerful driver of capital flows and of currencies. And in this case, if the US is saying that we're going to cut aggressively next year, then that means that this has a negative impact on the dollar. The fact that the US growth is going to be slightly weaker next year than this year also means the growth rates also have an impact on currencies. Stronger the growth, the stronger the currency, typically. So that also means that argues for a slightly weaker dollar. Now, of course, a lot of things change over time. Growth rates may be lower than we expect or much higher than we expect, which may have an impact on the dollar. Or global growth may be stronger or weaker, which can have a stronger global growth means a weaker dollar. A weaker global growth means a stronger dollar. So, depending upon how these play out, but the fact that interest rates are coming down and growth is weaker in the US suggests to us that the dollar, which has been very strong in the last 10 years, might be weaker, or at least that is how it has traded in the last month. And ever since the Fed announced that it's going to cut rates, the dollar has been trending weaker. So, of course, those are trends that we are seeing. A trend is not a fact, but these are some of the things that we think are can help or make the dollar weaker. And then again, that is great for emerging markets. I'm going to talk 5 more minutes and then pause for your questions, because I think the most important aspect of this interaction is when you ask me questions and I respond to those, rather than me talking all the time, because there's so many things to talk about the global economy, so many things to talk about the dollar, rates, FX, etc. One area that I do want to talk about is that we are entering 2024 with a huge number of elections in many countries. We start with elections in Taiwan. And for those who are reading up on what is happening in Taiwan, it is a very, very closely watched contest because the US-China relationship has found a tension point, a stress point in Taiwan. China thinks Taiwan is its property and its country. The US does not. And the Taiwanese elections will have a big impact on that. So we have an election in Taiwan. We have a big election in Indonesia, where President Jokowi has finished 10 years. There's a 2-term limit. He cannot run for elections again. And so, his defense minister Prabowo is fighting. There's 260 million people in Indonesia. So that's a very important election, which can determine the direction of that country. And of course, we have a big election in our own country, which everybody knows about, which I'm not going to talk about, which is in May, over 900 million people to vote. We have an election across the border in Pakistan, where Imran Khan cannot stand, but Nawaz Sharif is standing for prime minister in an election which is heavily controlled by the army. But it is an important election. A lot of things can happen, right? And then in the developed world, there's a large number of elections, including in the United States, right? There is a lot of debate whether it's going to be Trump, whether it's going to be Biden, who's going to be US president. That can determine foreign policy. It can determine the economy. It can determine relations towards Russia, towards China, towards India. There's lots and lots of ramifications of who becomes president. I'm not going to delve into what four more years of Trump might mean or 4 more years of Biden. But these are important points to note for students of economics and geopolitics that these elections are coming, and they're coming all in 2024. There's elections in Mexico, another large country, right? Where AMLO, who is the current president, cannot stand again, but his party is expected to win. There are elections or there could be elections in the UK. And then there are elections in a handful of other smaller countries like El Salvador, et cetera, which we're not going to go into. But I'm trying to give you the sense that the risks during elections to geopolitics, to economics, to the global order are greater than between elections, because there could be many different attempts at hankering for votes or trying to influence votes or trying to make pledges or doing something crazy. So watch out for that. It is going to be an interesting and exciting year, 2024, with all these elections happening, and we don't know which ones can cause the biggest damage. So, but something to watch out for. And of course, the broader point is that geopolitics is going to matter, not only next year, but going forward. I think in the last 2 years, we've seen how much it matters for the global economy. When Russia invaded Ukraine, we all felt the pain, right? Oil prices went through the roof, food prices went through the roof. So everybody had to deal with higher pump prices and higher food prices. We also had to deal with slower growth. Everywhere there was slower growth. We also had to deal with supply disruptions. We had to deal with greater defense spending and greater uncertainty. We don't know when war is going to knock on our borders. So it really changed the world in a meaningful way. So we don't know where next, right? It could be Taiwan, it could be Kashmir, it could be Arunachal Pradesh, it could be Gaza, it could be the Mexican border. There's so many flashpoints which could erupt that we need to pay very careful attention to these flashpoints and their implications for economies. The other thing I would add is that we've had a year, 2023, where every single month, almost every single month, has been the warmest month on record. Okay, so we had the hottest April, the hottest May, the hottest June, the hottest July, the hottest August, the hottest September. So we've had very, very warm months, which means that climate change is here. It's affecting all of us already. We've had the development of El Nino, which is already ravaging parts of Latin America. They are in drought when they were expecting rain. Who knows what 2024 can bring in terms of the impact of the climate? So that's a risk to my sort of more positive scenario. I said that it's a very benign global environment from the macro variable standpoint and policy standpoint, but geopolitics and climate change are two factors which are factors that all of you should watch out for that can have negative impacts on our risks to this outlook. We don't know where the next big drought or massive cyclone or hurricane could come from and how much damage it could cause. We don't know how much flooding might happen from incessant and excessive rain, et cetera, right? So that is something that we should be aware of and we should watch out for. The one positive development that I want to add as a positive risk, since I've highlighted all the negative risks, is as all of you are aware, there is a huge amount of change happening in technology. You, as students, you're reading about the development of artificial intelligence. And I'm sure all of you, or if not most of you, and if you're not using it, then you must, are using ChatGPT in some way, form, or the other to access the world's information and knowledge in your fingertips. It's almost as big as the internet, and it portends to be larger and bigger. So that is a positive supply shock for the global economy. In terms of your aggregate supply and aggregate demand curves, the aggregate supply curve is shifting outwards. So understanding that, studying the implications of technology and its impact on the macroeconomy and so on is going to be very important going forward, because this is a huge change, and there are many ramifications of this for our economies, for our jobs, for our societies. So as you look out, we're going to see much more evidence of the impact of AI on our lives next year, and of course every year going forward. This is something to watch out for. It is going to start showing up in our data at some point in terms of higher productivity and higher growth rates, because I actually fundamentally think it's a positive change which is going to increase human productivity and overall labor productivity for the white collar jobs, but it has a lot of societal and job implications for sure. So those are my thoughts. I try to give you an overall view of where we are in the global economy, talk about the view for emerging markets, the dollar, the risks in terms of geopolitics, climate change, the positive risks in terms of AI. But really, so I've gone on for 35 minutes now. I really want to take your questions. So if you want, please write your questions on the chat so we can address it. It's just like a classroom, we love whenever we have lectures like this, the interactive part where you don't understand something or you want to delve deeper into something is the most important part. So don't feel shy. There's no question which is silly or stupid. It's only the unasked question that is a problem. So if you want to type in on the chat, let me have your questions.
Students, you can also unmute yourself and you can ask the questions. You have option to do that also.
Right. So Kapil asked the question, what are your views on the volume of international transactions in dollars? Okay, that's a great question. So the question is that we are seeing increasing amounts of trade being denominated in currencies other than the dollar. For instance, India is trying to diversify away from the dollar by using trade in INR. So is China, trade denominated in RMB. So is Russia, trade denominated in ruble. However, currently these are not amounting to much. These are really small flows of trade. Ultimately, it's the country with the trade surplus that decides how it wants to receive the money, right? And let's say, for instance, Russia has a big trade surplus with India because India is buying oil and paying it in rupees. But what is Russia going to do with the rupees? It has imported whatever it wanted to import. So at the start of this year, we found that there was a lot of Russian rupees, Russian assets in INR, which is sitting in Indian banks doing nothing, which the Russians didn't want, because they want something that they can buy things internationally with. So I do think that this is a little bit of a red herring in the sense that it does not sort of take away the um, dollar's preeminence as the most important currency. For trade, most transactions are still denominated in dollars, but really it's for financial transactions which outstrip trade transactions by many, many multiples, right? Many, many multiples of capital flows, whether it's portfolio flows, whether it's FDI flows, whether it's other flows, they are much, much larger than trade flows, and those are still denominated mostly in dollars. So, it does not look like the dollar is going to leave its status as the preeminent currency of the world anytime soon. Okay, Kapil, I hope that answers your question. Ronak asked a similar question. Maldives government change impact on India. I think it's really small to matter. India's trade is mostly, our deficits are mostly with China and with the oil countries because we import so much oil. And they don't want our INR because what are they going to do with it? They can't do anything with rupees. So ultimately, it depends on the creditor, right? The creditor, if you have two friends, okay, one friend says, okay, I'm willing to lend, you rupees, but if the creditor, which is your other friend, says, look, you can give me rupees for buying services from me, but I have a surplus with you, so I need dollars. What are you going to do? Well, you can't use that rupee anywhere. That's the problem. Sorry, that example didn't work very well, but you get the point when it comes to countries. Raj Singh asks, thank you. The market is pricing in a cut starting March. With core still sticky, do you think that is too dovish? Is the Fed really going to pivot so soon? Given headline is down due to fuel, which is non-core, was the current pivot by Fed? Great question, and goes to the heart of what we're discussing. Raj, thank you for that question. Yes, that is something that the Fed will have to struggle with over the next 3 months. The Fed is expecting data on inflation to continue to be soft going forward, and it has good reason to believe that because housing rents are coming off, right, which is a big driver of inflation. And then, used car prices are coming down. There's other individual components are coming down apart from the broad-based reduction. So the Fed has not done this lightly. They've seen a lot of data points and they feel that inflation is going down and they don't want to leave the rate cuts too late. Because remember that there is a lag in monetary transmission. If you cut rates today, it's going to have an impact on the economy in 2 to 3 to 4 quarters. So if the Fed starts cutting in March, it's going to have an impact by the end of 2024 or even in 2025, right? So that's why they don't want to leave it too late. They made a mistake by waiting too late to hike, which is what led to inflation run riot. And that's why they're signaling that they want to pivot and they want to pivot. But could it sort of move from March to, let's say, May? Yes, it might, but it's hard to think about a situation where they don't cut in 2024, right? And they don't cut significantly in 2024. So that's sort of the way to think about it, is that you may get a delay of 1 or 2 months, but the trajectory is clear, is that we are going down. And the risk really here is that the Fed is calling victory on inflation too soon. And if you do that, then you get absolutely no landing, which is the economy never settles down to equilibrium. Wage growth remains strong. The output gap is still closed, which means that there's no slack in the economy, and unemployment rates have not gone up in the US, which then means that inflation will flare up again at some point next year. And at that point, you can't go back and start hiking, right? So that's the risk that the Fed is playing with. So that is a really great question on the risks. But in their judgment, they think that they're done and inflation is coming down. And data so far has been proving them right. every data print on inflation is coming softer than the previous one. So far they've been right, but only time will tell how right or wrong they are. Any view on the recent developments in the Suez Canal? What might be the max upside in risk in crude, given record amounts of production by the US along with African nations, the UAE? Not really keen on further production cuts. Okay, great question by Aryan. Yes, we are seeing a lot of pressures on oil in both directions, right? On the one hand, oil demand has been weaker than expected, especially because of China. And supply has been actually really strong, and that's partly because of the US. But if I look at a large number of countries, I was recently in Kazakhstan and Azerbaijan, and they're pumping out more oil and gas than they were 2, 3, 4 years ago, and they're going to pump out even more. That's true for Russia, which is not being able to sell its oil. That's true for Venezuela. There's a lot of countries which have supply potential. So the supply bottlenecks are lower now than they were, but demand has also been weaker mainly because of China. So the mix and the Suez Canal problem is really a temporary spike. We do hope that trade is going to be restored, and that's causing this pulls and pressures in oil. Hopefully that's going to subside. It seems like the Gulf countries and OPEC are happy with oil prices around $80 to a barrel, which seems to be a midpoint. I see risks on both sides of that, but it's extremely hard to call oil prices. I would say that I don't see any strong reasons for a big spike up in oil prices unless supply is really cut off somewhere. And as I said, there's increasing supply capacity in the US and elsewhere to mitigate that. Neither do I see a sharp fall because OPEC keeps cutting production whenever oil prices fall quite dramatically. So it seems like it's sort of, hovering around with a midpoint of near 80. But, again, it's things change very rapidly in that market. Meher asks, with the immensely increasing use of AI in everyone's lives, do you agree that it can cause unemployment to rise on a large scale? Please give your stance for or against. Okay, my stance. Wow, I thought you'll ask me for my views. Glad it's the stance. It's I'm still learning. I'm still educating myself on what AI would mean for the job market, etc. Look, every technological change when it came about had a lot of believers and a lot of disbelievers. A lot of people who said, "Oh, it's going to destroy jobs." When the motor car came, everybody thought that it's going to kill all the horsemen and all the people who are running carriages and Ghoda Gadi walas and all of these people, right? All of them are going to lose jobs, etc. In the end, it created more jobs, because people could travel faster. A bus could accommodate a lot more people. An airline could accommodate a lot more. And so in the end, in aggregate, any technological innovation which boosts supply creates more jobs than it destroys. Of course, there are going to be people who are directly affected by that technology who will lose their jobs or who will have to reskill or find something else to do, right? And that's what you find, when computers came in, there was a lot of brouhaha about, okay, we're going to lose jobs in the typewriters are going to go away, the secretaries are going to go away, all the support stuff are going to go away because everything's going to be done on the computer. Yes, but those jobs didn't go away. The secretaries, instead of using the typewriter, started using the computer. Processing of information became easier, right? Those who were doing useless jobs or low productivity jobs went away. So I'm generally optimistic about technological change. I think that this technology can actually help. Of course, it's too early to say, and you and I and students and innovators will have to continue to learn much more about this technology and how it impacts all of us. But I'm not pessimistic at all. So if you call that a stance, I do have one. Okay. Next question. Will it be hard for Saudi to break even on their fiscal budget? Break even on their fiscal budget with prices sub $80? That's a great question, Aryan. I can't exactly recall what is the break-even price for the Saudi budget on oil. I think it's around that amount, 80, which is why they want to keep it there. But there is some flexibility. They've had a lot of surpluses and they've got a massive sovereign wealth fund, so they can try to reduce some spending and have some excess savings that they can use to bring forward, even if prices fall to below 80. But yes, they do want to keep prices to $80, and that is something that they would like to hold on to. Next question. How do you filter countries within emerging markets? What parameters would be relevant to peg, let's say, India against the Korea, Mexico, other secular stories? I'm trying to understand what your question means. So are you trying to tell me how to compare across countries? Do you want to unmute and ask me a question? Because I'm not 100% sure I get the question.
Sure, sir. So basically the question is, when there's a risk on sentiment, we do see portfolio flows going into emerging markets. That's there. But then how do we sort of, especially you being in a place where you have to sort of allocate your budget across different countries, and like how would you evaluate in India against, let's say, China or Korea or Mexico? I mean, these are countries. I mean, some of these countries are doing really, really well. So like, how does that play out?
Great question, Raj. Great. I can give you a half an hour answer, 10-minute answer, but I'm going to try to give you a 2 to 3 minute answer because that's the amount of time we have. But that's basically what I do for a living, is try to compare countries. So the 2-minute answer is that there are credit ratings assigned to each country, which is basically what is the external profile of that country. And that credit rating ranges from AAA all the way to CCC, and sometimes even D, right? And these are, so rating agencies give ratings to each country based on that. Similarly, I give a rating to each country that I cover. So India is a BBB minus country, so just above investment grade. And that is because of the rate of a number of factors that we look at. We look at growth rates, we look at inflation, we look at the health of the fiscal or the government balance sheets, how much debt they have. We look at the external balance sheet, how solid is the external balance sheet, how big is their current account deficit, how much external debt do they have, what is the debt servicing, how much reserves do they have to meet that debt servicing. So it's really a complete health check of the economy. It also looks at other vulnerabilities, like is there a banking problem? Is there a corporate problem? Is there a problem with households? So what are the overall debt levels in the country? So we look at all of these indicators to come up with a credit rating for the country. So, a Brazil is rated much lower than in India. It's rated at a BB level. India is BBB, they are BB. Okay. Mexico is very similar to India. It's also close to a BBB minus. China is much stronger in terms of rating. It's in the A category. So every country falls into a bucket based on rating, and that's what we do. And I would encourage you to read up more on sovereign credit ratings as a way of classifying countries or comparing across countries, because it's a very interesting, easy, and direct way of comparing and contrasting different countries. I hope I've tried to answer your question 2 to 3 minutes, but as I said, I can spend a lot of time in that. But this is a great question. Kavya asked, is there any chance of I'm easy being successful now that Israel-Hamas war has soured relations between Middle East and Israel, considering Haifa port is essential. In this regard, what does it mean for India and the search for an alternative to Belt Road Initiative? Great question. I wish I could have more insight into this. I think this issue is still being played out, between Israel and Hamas, and I think it might be too early to tell. This was just an announcement that was made this year on the G20. So it's too early to form a view on this corridor that India has signed. I think the intentions are right. The Belt Road Initiative has been going on for much longer and has much bigger impact globally than this corridor. So I would, it's still very early days to have a very strong view on this initiative. But so I think we may have to wait for the next 3 to 5 years to actually understand what this means. But no, I don't have a huge amount of insight on these trade routes and initiatives yet. Okay, where do you see the 10-year Indian yields post JP Morgan index was starting June 24 is a case for tighter rate? I wish I knew or was able to tell you what the 10-year rate is going to be. It's a very, very market-oriented question. But yeah, I think it's going to be hard for the RBI to hike interest rates anymore. But given inflation is at 5.5%, it's going to be very hard for the RBI to cut rates as well. So it looks like the inflation rate Indian interest rates are held in a tight range. I think fiscal policy can be important here, and that will be determined by how much fiscal policy is loose by the government. Right now, they're saying that they're going to stick to the budget, the fiscal deficit targets, but it's going to be very difficult to know how much spending that they're going to do just before the election. There are 4 months left, Jan to April before the elections. So, that's when you're going to see a lot of spending happening on the fiscal, which might have some impact on the 10-year yield. Which sector do you see value migrating towards in India other than coming years, Mr. Upcoming elections, investment in emerging markets? Sakshi, I thought this was more on emerging markets overall and broad macro. Going to go into sectors. That's not my huge area of expertise either. To give you stock tips on this call, I would encourage you to look at other experts to do that. But yes, I think India's growth dynamic is really, really strong. Many sectors doing really well. So I think you'll have to do your own research on this, unfortunately. I wish I knew the answer to that, but I don't. Okay. I think we've come to the end of the questions. Very, very insightful questions. I hope I've answered most of them. Some of them, which were very specific to trade recommendations and all, I've not been able to for obvious reasons, such as what to do on the 10-year or what to do in which sectors to invest in. But I think overall, you guys have been great audience. Keep engaged with MDAE. We keep doing these webinars. Keep sending us your details so we can invite you to more. Come visit the academy. Keep engaged, and we hope the learning process can continue for you, for us, and for everybody involved. Good luck for next year, and wish everybody a Merry Christmas and a very happy 2024. Thank you. I'll say my goodbye now.